The last few months have been exceptional for M&A activity, which has rebounded to record levels.
Q1 of 2021 has been another record-breaking period. So M&A activity is continuing to smash records, and worldwide activity totaled about $1.3 trillion, which is an increase of 94% compared to year-ago levels. And it's the strongest opening period for M&A since the records began in 1980. It really has been an astounding start to the year. And we, of course, saw a strong recovery in the second half of last year, and it seems that this is set to continue and even to accelerate. So let's talk about what kind of deals we're seeing. So there's a couple of key themes here. Private equity continues to be very active, hitting an all-time high recently. Private equity buyouts accounted for about 20% of M&A activity in Q1, which is double from a year ago and continues the strong finish we saw late last year. SPACs, another headline-grabbing sector, accounted for about 17% of Q1 activity, and by all accounts will continue to drive volumes this year. Now, if we look at this globally, the US markets dominate M&A activity, accounting for about half of all global deals in Q1. And this is noteworthy because, as we discussed in previous sessions, the US was behind the other regions late last year, largely due to uncertainty around the presidential elections and COVID response. But that lost ground is now more than made up with very healthy figures. Asia saw a good increase in activity, and while Europe was also up, it was slower growth than the US and Asia. In Asia specifically, Q1 levels are at a 6-year high, so it's really healthy market activity. But interestingly, Japan is at a 2-year low, which clearly signals more growth opportunities elsewhere in the region. Now, in terms of sectors and industries, technology continues to go from strength to strength, and we saw an all-time record for tech M&A where the numbers tripled. Alongside technology, other sectors that have been very healthy are financials and industrials that really close out the Q1 activity.
Part of the volume story is the resurgence of the pandemic lows, but the response from policymakers and the resilience of capital markets has provided very fertile grounds for deal-making.
So obviously the big question is, what is it that's really driving all of these record volumes of M&A activity that we're seeing? And there are a couple of clear factors here. So the pandemic crisis last year meant that we saw a rapid shift. Large corporates spent time in recovery and damage control mode. They shored up the balance sheets and operations, and then they started looking very actively at how to grow and secure the businesses. And this resulted in a strong focus on M&A. So for large corporates with solid balance sheets, this is a good time for M&A activity. Equity markets are high, investors are willing to pay for growth, and interest rates are low. So this also means that assets that may not have been for sale otherwise have come onto the market, and generally there's a greater willingness amongst the corporate C-suite to engage in deals. It's very much a case of what was initially seen as a massive challenge last year has now become the new normal, and companies are ready to move forward. So it's a good time to reshape a business and focus on growth, and I think that we will see some strategic divestitures as a result as well. Another factor here is, of course, private equity. So private equity is a big driver of M&A activity, accounting for about 20% of Q1 activity so far this year. And when it comes to private equity, market turmoil really creates the perfect conditions for well-funded and well-experienced deal makers that can move quickly. And that is PE. They are perfectly placed to take advantage of new opportunities in the current market conditions. Now, add also the fact that there's significant dry powder at play. So i.e. capital ready to be deployed by the private equity firms, and we're likely to continue to see PE push deal activity. And lastly, let's not forget about the capital markets, as you alluded to. So we'll do well to remember that all M&A activity requires funding, and typically this comes from the capital markets, where conditions have been very favorable and record-breaking amounts of capital have been raised, both through the equity and the debt market. So 2020 was very much the year of the capital markets to the rescue, with strong growth, meaning that corporates are now unusually well placed to execute deals. We should probably also at this point talk about SPACs, right? So SPACs is obviously it's a headline-grabbing sector of the market, and 2020 was the year of the SPAC race. It was the return of the SPAC, with the special purpose acquisition companies really coming to the forefront as a driver of corporate takeover activity. Somewhat to some observers' surprise, I think. And based on the first quarter of Q1, we're looking at an even higher level of SPAC activity. So far, SPACs have broken all volume records in 2021. In the first 10 weeks of this year, more SPACs listed than in all of last year. And proceeds were almost at a par to roughly $80 billion. So I think that is a clear indicator of things to come.
This rebound doesn't just feel like a one-off recovery. Dealmakers themselves are expecting the momentum to be maintained.
Every year, Refinitiv speaks to about 500 deal makers across the M&A and capital markets to gauge their confidence and outlook for deal making. Now, the outcome of this year's survey is really fascinating, and global deal makers are overwhelmingly positive. There's a strong bullish sentiment, and most expect 2021 exceeding the dramatic recovery and record-breaking volumes that we've already seen. And of course, people are still worried about external risks. There's the pandemic, slow economic and corporate growth, fear of trade war, fear of recession, really top the list of those external risks. But none of these are enough to really hit the brakes and slow down that M&A train. It is full steam ahead. Interestingly, previously big themes such as US politics and Brexit have dropped off the agenda and seem to be much less of a concern these days. Now, in terms of predictions, deal makers expect an uptick in M&A activity of about 6%, and capital markets at a similar level. US deal makers are more bullish than our European and Asian counterparts, where we expect to see lowest growth in Asia. Top sectors are slated as technology, not surprising, and also healthcare. And these are predictions I very much agree with. I do also wonder if part of the reason for the bullishness of our American deal makers is due to SPACs and the very, very healthy activity there. Sustainability is becoming an increasing driver of deal activity. Refinitiv publishes a quarterly sustainable finance review, including league tables, and a key theme is that corporates as well as banks now have sustainability targets and goals, such as putting a specific amount of capital to work in sustainable areas. And this really means the existence of sustainability targets means that we're very likely to see a shift of M&A as well as capital raising activity towards sustainable assets.
M&A volumes have benefited from the environment of cheap and easy funding and the deployment of war chests that had been built up prior to the pandemic. SPACs are providing venture capital style risk rewards, while sustainability is again building momentum as a key driver of capital flows that look like they're going to continue through the rest of 2021.